You know that feeling when someone casually mentions they made $10,000 last month from investments and you're sitting there thinking, wait, I thought you just put money in a savings account and crossed your fingers? Here's what nobody tells you. There are 12 completely different ways to invest, and most people only know about 2. The other 10 are quietly making people rich, while everyone else wonders why their bank account keeps showing the same depressing number year after year. I'm Uncle Charlie, and I've watched people retire at 50, and I've watched people work until they drop. The difference wasn't intelligence or luck. It was knowing where to put their money. Today I'm explaining every investment type in 10 minutes. No boring textbook definitions, just what actually works and what's a waste of time. Let's go. Stocks. When you buy a stock, you own a tiny piece of a company. Sounds fancy until you realize your single Apple share doesn't get you a free iPhone or a seat at board meetings. Here's what actually happens. You buy in, the price bounces around like a caffeinated squirrel, and you either panic sell at a loss or hold on and let compound growth work its magic. Stocks historically return 10% annually, which beats everything else long term, but the daily swings will test your sanity. Most people buy high when everyone's excited and sell low when everyone's panicking. It's like joining a gym in January, going twice, and quitting because you're not shredded by February. Stocks reward patience and punish emotion. Buy good companies, ignore the noise, and check back in 10 years. That's the whole strategy, but 90% of people can't do it because watching numbers go down feels like personal failure even when it's completely normal. Bonds are the boring friend who always pays you back on time. You lend money to a government or company, they pay you interest and eventually return your principal. Returns are lower, maybe 3 to 5%, but you know exactly what you're getting. No surprises, no drama. The catch? When interest rates rise, bond prices fall. So, if you thought bonds were risk-free, congratulations, you thought wrong. They're safer than stocks, sure, but nothing in finance is actually safe. Bonds exist so you can sleep at night, while stock investors are refreshing their portfolios at 3 in the morning, wondering if they should sell everything. ETFs are baskets of stocks or bonds bundled into one investment. Instead of buying 100 individual companies, you buy the whole basket in one click. Instant diversification. If one company crashes, who cares? You own 99 others. The fees are tiny, sometimes less than 0.1%, which means your money stays invested instead of funding some manager's yacht. Here's where people mess up. They buy 7 different ETFs thinking they're diversified, but all 7 hold the same companies. Congratulations, you just complicated your portfolio without actually reducing risk. One good ETF tracking the total market is better than 10 bad ones pretending to be different. Real estate. Everyone thinks they understand it because they live in a house. Buying property to rent out can build serious wealth, but it also makes you a landlord, which means dealing with tenants calling at midnight about clogged toilets. You need a huge down payment, ongoing maintenance costs, property taxes, and the patience to wait years for appreciation. The upside is monthly cash flow and leverage, meaning you control a $300,000 asset with $60,000 down. When prices rise, your gains are amplified. When they fall, so are your losses. Real estate is a second job disguised as passive income. If you love fixing things and dealing with people problems, great. If not, you'll hate every minute. REITs are real estate without the landlord headaches. A real estate investment trust owns apartment buildings, malls, or office towers, and you buy shares like a stock. They collect rent, handle management, and pay you dividends. You get real estate exposure without unclogging a single drain. Prices fluctuate like stocks, and you have zero control. But for most people, that's a feature, not a bug. Why spend weekends managing properties when professionals can do it and just send you checks? Cryptocurrency. Half the internet says it's the future. The other half says it's a scam. The truth? It's volatile speculation that might pay off huge or might disappear entirely. Bitcoin could be 60,000 today and 30,000 next month. People who bought at $100 and held are wealthy. People who bought at the peak and panic sold lost everything. Treat crypto like a lottery ticket. 5 to 10% of your portfolio maximum, only if you can stomach watching it swing wildly without losing sleep. The rest goes in boring, stable investments that won't give you a heart attack. Mutual funds are actively managed by professionals who think they can beat the market. They charge 1 to 2% annually for this service. Here's the dirty secret. Most don't beat the market after fees. You're paying someone to underperform what a cheap index fund delivers automatically. That 2% fee sounds tiny until you realize over 30 years it steals over $200,000 from your retirement. You're funding someone's vacation home while eating ramen in retirement. Skip mutual funds unless you find a genuinely exceptional manager, which is rarer than you think. Commodities are physical goods like gold, oil, or wheat. People buy gold as insurance against disaster. When everything crashes, gold holds value. The problem? Gold doesn't pay dividends or interest. It just sits there looking shiny. You're purely betting the price rises. A small allocation makes sense for diversification, but commodities shouldn't be your main strategy. Think of gold as a financial fire extinguisher. You hope you never need it, but it's nice to have when everything's burning. High-yield savings accounts aren't investments, but they're where emergency funds live. They pay 4 to 5% interest and are FDIC insured up to $250. You won't get rich, but you won't lose sleep over market crashes either. This is your foundation. Cash you can access immediately without penalties. Every plan needs boring, safe money before taking risks elsewhere. Alternatives include private equity, hedge funds, art, collectibles, startups, anything weird that doesn't fit elsewhere. High risk, high reward usually requires serious capital or connections. For 99% of people, skip it. Stick with stocks, bonds, and real estate. You'll do fine. Alternatives are for people who've maxed out traditional options and want something different. Just know mistakes here get expensive fast. Here's what separates people who build wealth from people who stay broke. The wealthy diversify across multiple investment types: stocks for growth, bonds for stability, real estate for cash flow, a little crypto for upside. They don't panic when markets drop because they know fluctuations are normal. They don't chase hot trends because they understand time beats timing. And they start early because compound growth needs decades to work its magic. The average person does the opposite. They keep everything in savings, earning nothing. Then panic, buy stocks at the peak because everyone's getting rich. Then sell at the bottom when it crashes. Then swear off investing forever and go back to earning 0%. It's financial self-sabotage on repeat. You want to know the real secret? There is no secret. Buy diversified investments. Hold them for decades. Ignore the daily noise. Don't sell when markets drop. Add money consistently. That's it. Boring wins. Exciting loses. The people driving fancy cars with massive payments are usually broke. The people driving 10-year-old Hondas are quietly building wealth. Choose which one you want to be. If this helped, subscribe. Next video covers retirement accounts and how to actually use them. You'll want to see it. Now, go invest something. Your future self is counting on you.